And then, so once you do your bottoms up forecast, you also want to think about a tops down forecast. The tops down forecast is the forecast that you use to create the slide in your pitch deck that basically says, what's the overall market that we're going after? What's the segment of that market that we think we're going to attack? And how much of it do we think that we can get? This is kind of a BS approach, and it's not a lot of use. But it's something that everyone wants to see. And the reason people want to see it, first of all, venture capitalists want to see it because they want to make sure that they're investing in a big opportunity. So VCs are not going to put money into an idea or into a company unless they think there's the possibility of a major return. So without the possibility of a major return, you're not going to get venture capital. That doesn't mean that you can't raise money from angel investors. That doesn't mean that you don't have a great business idea. That doesn't mean that you can't bootstrap something. But unless there's the possibility for the huge market potential and the hockey stick, it will be very, very difficult to raise venture money. So all this slide is doing is validating the idea that there is a large market that you're going after. So we'll typically see this slide. We'll see folks that have a major market that'll be a $15 billion market, and they'll talk about if we get 5% of that, or if we get 2% in the first year, 3% in the second, third year, and X in the fourth year. It's all bogus, but you do want to think about it in terms of just validating the fact that you do have a major market. So top-down projections, start with the market size, identify the segment you want to go after, and extrapolate how much of that market you think you can get.